Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And I'm super excited today to be talking to one of the OGs of the ASX trading industry. He is in fact Twin, and that is his real name. And you won't get to know much more about him than that. But I can promise you, you're in for a treat in terms of what he has in anonymity. Has even more in terms of trading experience and expertise that he's going to share some of that with us. Today, we're going to be talking about rare earths in particular, which is super interesting and a topic that I know basically nothing about. And we're going to have, of course, our ROI segment where Twin will tell us about some of his major wins, and we can hopefully learn a lot from that as well. Quick bit of housekeeping, guys. Anything that we say during today's chat or outside is purely our opinion. It's just meant to be an entertainment slash educational discussion. Please don't mistake any of this for financial advice. It is not. It's purely our opinion. Two guys that like trading and what we're doing with our money. So having said that, Twin, how are you, my friend? Thank you for coming on the podcast.
My pleasure, Ben. Thanks for having me.
Pleasure is all mine. I might get you to start off just with a brief background as to yourself and what got you into trading, and tell us a little bit about what your trading style is and the plays that you like to make on the ASX.
Yeah, sure. So, I suppose a bit of background. I've been trading ASX stocks for probably over 20 years now. Um, as a young pup, my dad was a bit of a stock trader. He's a lecturer in sort of economics and commerce and was always involved in trading. So, sort of from a fairly young age, I was always interested in trading. Throw into that I'm sort of that generation that sort of just grew up with the early internet. So back when we had things like bulletin board services and you know stock forums and all the stuff that sort of went back on sort of 20 or 30 years ago. Um, and I've got a degree in information science. So um, when you combine computers, data, and finance, you sort of just tend to find yourself into stock trading. Seems to be one big computer game at times. So it's just one of those really interesting things. So a lot of people have probably seen me around the traps over the last 20 years. For about the last 15 years, I've been a heart on hot copper. So for those that don't know, hot copper is Australia's largest stock forum. And when you're one of the most followed on hot copper, you become a heart. So I think it's the top 30 traders on hot copper get followed, get a heart. And I've been that constantly for the last 15 years. So and before hot copper, there were some of the original forums like Crazy Jim Smith and Aussie Stock forums, and so I've been around a while. So I've just sort of been a bit of a mug punter for the last sort of 20 years, but along the way you tend to pick up a few things, and when you have an interest in it, when you're sort of the sort of guy who goes to bed reading stock presentations and announcements and that sort of thing, you just tend to learn a bit over the years. So yeah, it's been a fun ride. It's been interesting.
I think you've learned a little bit more than a bit and done a little bit better than the average mug punter. In terms of your experience, one thing that you like to do is help people steer clear of some of the bad actors out there. Maybe break down, are you a fundamental analysis reading these reports? Are you a buy and hold investor? Are you a quick flipper? Are you quantitative, purely quantitative driven? What's some of your process, and how did you come to have the faith to systematically repeat that process in order to generate your trading success?
Um, I think with myself, you had to learn the hard way. So I suppose one of the things I've tried to do over the last sort of 15, 20 years is help people avoid some of the pitfalls that I've come across. And unfortunately, I would like to think the ASX and ATSIC have everyone covered and safe, but at the end of the day, that's always not the case. So I suppose I've been partly known over the years for being that one negative voice in the sea of pumpers. You'll get people who see the ASX as an opportunity to make money, and when people make money, sometimes it clouds their judgment on what they should and shouldn't do. And I suppose over the years, especially early on in my career, would get sucked into some of these hype stocks, and over the years, you learn what some of the red flags are. What are some of the things you should be looking out for, some things to avoid, some warning signs. And then when you start to learn about geology and grades and economic deposits, what makes something economic, what doesn't make it economic, you tend to, it's hard to stay silent when you start to see people giving misinformation on forums and stock markets and stuff. So there's been some doozies over the years. I remember back in the day, there was a stock called Kudeco, which was going to be the next major force in copper in Mount Isa. And, it was one of the lone voices on that saying, hey guys, I don't really know if this is as good as everybody's making out to be. It had all the drama of a modern soap opera. It had for those that don't know, it had baby John Burgess do the presentations, the Wheel of Fortune guy,
That's always a bad sign, surely.
It had presentations with rock music and thunderbolts. It had everything back in the day, and it was really one of those stories where it was I think it was probably worth over $1 billion at one stage, and it ended up going broke just because it was fundamentally a bad mine.
And so you saw the hype, and what were the red flags in terms of that made you stay away? Was it purely reading through the drill reports? Was it looking at this and saying, this balance sheet is terrible, it's not going to be able to survive to production? Like, what were the underlying factors that helped you realize this was definitely something to avoid, not to be caught up in the bright and shiny lights?
But mate, there are so many different things that you can pick up on. I think game show host is probably one of the big ones. But in all seriousness, there are some red flags, and it's one of the things I warn some of the investors about. It's things like convertible notes. I'm a big believer of that if a company has to resort to convertible notes, then that in itself is a warning that the company can't get proper financing. So a convertible note is effectively a rolling capital raise. So what you see is a company will take a convertible note, and every month they'll issue shares, and they might issue $1 million worth of shares every month, right? And they're giving it to the convertible note taker at a discount. So they're saying, oh, we'll do it at a 10% discount. And what tends to happen is the convertible note taker will get issued the shares, give the company, the $1 million, and then they'll immediately dump those shares on market because they've got them at a discount. They've got them at like a 10%. So they're making a 10% profit. And then what happens is the next month comes around and they get another $1 million worth of shares, and the company will then again dump them on market for a profit. And you get this, what they call a death spiral, which is effectively the selling pushes the price down. So the next raise is cheaper, and then they sell again, and then the next raise is cheaper. So every month the share just gets cheaper and cheaper and cheaper and cheaper until they get sort of written off into oblivion. And it's one of the things that the guys that have been around sort of the ASX for a while, if they see a company do a convertible note, they'll typically sell their holding just straight away.
Wow.
Just because of it's not necessarily the end of a stock, but what it does, it just applies a constant downward pressure, which is really hard for a stock to overcome.
And is that on two fronts? Because your existing shareholders are getting diluted to kingdom come, and then you have this downward selling pressure purely on the price action, because there's that arbitrage between the notes being issued at a discount and then people dumping them on the market. Is that fair to say?
Yeah, but basically, so what tends to happen is you just constantly have this drip selling effect. So even when it's quieter, you've still got this selling happening, and it doesn't hurt the note taker because their next issue of shares is at a discount to the volume weighted price. So they're always getting a discount. And then typically what you'll find in a notes agreement is that there's a minimum around volume and there's a minimum around price. So they might turn around and say, it might be $1 stock, and they might say, if the stock drops below 10 cents or the volume drops below 1 million shares a day on average, then the note taker doesn't have to accept the next issue of shares. Okay. And effectively what it is the note taker doesn't want to be left holding the bag. And the way the note taker can get holding the bag is if the price drops too low or the volume drops too low, because they can't churn the stock that they've just received. So they need some daily volume, and they need a decent price to be able to offload their shares. Now, one of the things I've come out in the past is when these agreements come out, is, I make the comment of this is potentially the end of the stock. 90-95% of the time, eventually the stock will just end up in oblivion, because it just gets diluted. It goes from 100 million shares to 1 billion shares, all because of this constant drip feeding and selling and downward pressure of stock. So that's one of the red flags that I see. I've got my own, which probably make no sense to other people, but back in the day, I was involved in a company, a Gold Coast company called Cummins Corp, back in the 2006 era, when I first started share trading, and it was all about basically creating fish farms in car parks, which might sound really weird, but the theory was that you could get one of these boxes, and effectively you could farm fish in them, and you would have fresh fish for restaurants and whatever, and they'll modular and stuff. So so I sort of learned that if a company has a head office in the Gold Coast, then typically just run away. and funnily enough, Qudeco had an office in the Gold Coast. So that's probably a red flag for Qudeco.
Two very strong red flags. When you see the Wheel of Fortune being rolled out, and they've got an office in the Gold Coast, it's time to hit the road.
Yeah. So obviously, there's lots of other different red flags. I could spend all day talking about red flags on stocks, but when you're, the best way you can learn something is to live it. And I've done all the learning that I could ever do in the last 20 years. There's not many tricks and dodginess that I haven't seen and I haven't been involved in, and I haven't been caught out on, for me not to know something's dodgy straight away. Good example was, there was one recently, I think it was called Emerge Gaming. They came out and they'd signed this massive deal for their gaming suite, and came out with an announcement on the ASX. And they said, we've signed up this company in South Africa, da, 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 da. And it was effectively just a multi-level marketing company that was flogging stuff, in my opinion, to poor African people, with the promise of riches. So it was basically a pyramid scheme, effectively, and these guys had gotten involved in it. And when you look at the announcement and you did a Google search on who they'd done it with, then you found out quite quickly that they'd been banned in the UK for bad practice, and then their head office in Spain somewhere was like an empty building or something. Like there's enough things that you can sort of come across where you start to go, hang on a sec, a bit of a background check, a bit of due diligence on who they're signing a deal with. When they start to see them being flagged by overseas authorities, or they're the world leader in something, but then their LinkedIn has 3 people. They're things that you sort of learn that maybe they're stretching they're gilding the lily just a little bit.
Yeah, it might not add up. So let's talk a little bit about your trading style. Then we might talk about portfolio or trading book management.
Yep.
You're typically equities guy, ASX, long only, I presume, so no shorts.
For the first 20 years, I was long, but then when COVID hit, I saw COVID really early. I think it was January 2020. I was seeing what was happening out of China. So a little bit of a background. I lived in Japan for 3.5 years, working an IT gig. Part of that was international consulting for some of the banks in Asia. So I've spent a little bit of time in China and Thailand, and obviously 3 years in Japan. So when I started to see the stuff happening out of China, and I saw them welding doors shut and blocking tunnels with piles of dirt and all this sort of stuff, I went, hang on a sec, this could be a potential problem. So I was tweeting about COVID sort of 3 months before the market started to react to it. And that was the first time I'd actively taken some short positions. So went heavy into shorting Qantas and Flight Centre and Webjet and all those sort of typical stocks that were gonna struggle. It was interesting. Before I started shorting, I had such a long mentality that I started going long on hand sanitizer stocks and this sort of thing. Who makes hand sanitizer on the ASX? So,
That's brilliant.
yeah.
Okay, so delving into the shorts, and what's an average holding time for you? Are you looking for a quick flip, or are you looking for a slightly longer term hold? How do you come about making the decision to enter in and then exit a position?
So I think my strategy encompasses nearly every strategy you can probably do. So I will have day trades. So, I'm buying something in the morning, looking for some typical movement on a theme of some description and looking to flip by the end of the day. I can have overnight holds if I think that there's some sort of momentum, it's breaking out, it's doing something. I'm happy to hold for a day or a couple of days. And then I've got a whole bunch of things that I will want to hold long term for whatever reason. So I'm looking for some drill results. I'm looking at some corporate action. I'm thinking something's fundamentally cheap on a narrative. So it might be a lithium stock that I think is good and is undervalued, and it might take 3 months or 6 months for that to happen. A good example was about 15 months ago, I started to go long coal stocks because I saw that coal and the renewable energy story wasn't panning out the way that it was panning out, or wasn't sort of, and typically what we were seeing was that the coal price was going up on this theory that coal was dead. If you talk to the average Joe on the street and you said, "Oh, I just bought a coal stock," they'd be like, "You're an idiot." And the thing is the transition to renewable energy isn't going to happen as fast as the world would like. It's just, we have a whole bunch of issues around, supply of things like, lithium and copper and a whole bunch of things that make, and rare earths, which we'll get into, to help with that transition. And then there's a whole bunch of infrastructure issues. You can't just put a wind farm where the coal-fired power station was and use the existing infrastructure. When they build a wind farm, they want to build it where it's windy, which might not be where there's transmission lines, may not have the right infrastructure, might not have the right storage capacity. There's a whole bunch of issues. And I think what's happening that we're seeing, and we've probably seen now in the last 12 months, is that the whole coal is dead story isn't quite right. Coal's going to have to be around for a little bit longer yet. Definitely the coal price has gone from $100 a ton to $600, $500, $600 Australian a ton. And I was pretty early on, I was starting to see the coal price move up on fundamentals. And the coal stocks weren't moving up. And that sort of was around the fact that so many funds now, who are, at the end of the day, are big buyers of coal stocks, have ESG mandates that doesn't allow them to buy coal stocks. So I saw a bit of an opportunity. So with those sorts of stocks, I was happy to then hold them for a 12-month play, because I could just see that fundamentally Whitehaven at $2.40 was cheap. It hit $10, $11 the other day, and been paying dividends and whatnot. So there's definitely themes where I'll hold a stock for like a good 12 months or 18 months, but then I'm at the other end of the spectrum where I could hold something for 10 minutes. So anything in between.
Interesting. And in terms of position sizing or number of positions that you would be running at any given time, do you hold a really diversified book, or do you concentrate into a few names, heavily weighted positions, and you watch those positions closely? Talk to me about that.
I probably don't have any more than about 10 stocks on play at any one time. Only because I think if you look at your portfolio and you say, okay, some people have 50 stocks, and I say, okay, rank those 50 stocks in the ones you like most to the ones you like least. So once you get past about 10 and you start going into your 20s and 30s and 40s, I'll be saying, well, why have you got money allocated to the 50th one and not the number one? Like if your expectation is this is my top 10, well, why hold 50? You know, and if those 10 are diversified enough that, you know, that gives you enough diversification in my mind where, you know, I'm not going to go buy 10 coal stocks. Right? I'm not going to just hold because then I've got a risk. I'm not diversified. I've got a risk in the coal price, even though my thinking might be coal's a good play for 12 months. I don't have a magic 8-ball that tells me I'm right. And I think what happens is with investors is they can get so confident on a theory or a story that they pile all into maybe 5 different stocks, but they're all the same field. You know, they're all lithium plays. You know, then the lithium price goes down and they lose 50% of their portfolio in 3 weeks. You know? So I think it's good to have enough stocks that you're not going to get crucified if a company does a capital raise, or, you know, they lose a license, you know, or they go into a trading halt for 12 months, that, you know, that it breaks you. But on the same instance, I think having, you know, 30 or 40 or 50 stocks is probably too many, because you're only going to be allocating 2 or 3% of your capital to that stock. And if it triples, great, you know, but you've made 5% on your portfolio when you probably should have made 50% on your portfolio.
Yeah, it's super interesting to see, you know, diversifying across sector to reduce that sector risk. But then, you know, a lot of people delude themselves into thinking that they're diversifying, whereas really they're just diversifying through different equity names. So that's, yeah, it's an interesting way to look at it. I'd love to move on to rare earths, which you mentioned, because I have been listening to some of the content that you've been putting out around rare earths in particular. Briefly give us an explanation as to what the hell are these rare earth things, and why are they important? Where do we find them? What's their use case? And what's with all the noise currently being made around rare earths?
So, you know, I could probably spend 6 hours talking about rare earths, and so I'm going to give a very simplified view. So for the listeners out there, don't blame me if I make something sound very simple, right? Because, you know, there's a lot to it, but I'm going to dumb it down.
Please make it simple.
Yeah, the average person. So, you know, you'll remember when you're at school and you're probably sitting in science and they pulled out the periodic table and it had all the different things on the periodic table, and you just went, oh God, there's so many things I've got to learn, you know. And some things are really obvious, you know, oxygen, you know, nitrogen, gold, silver. These are all the things that people, you know, understand. They're just elements. You find them, they're in the air, they're in the ground, whatever, right? So there's a bunch of elements that are called rare earths, and they're actually not that rare, but they're called rare earths. What is rare about rare earths is it's hard to find them together in an economic deposit. So, you know, I can go out to the backyard, you know, do an essay on my dirt in the backyard, and I'll see all these varying different elements, right? Why I don't have a mine in my backyard is because they're not in concentrations enough to make them valuable, right? It's like gold, you know, there's gold in the ocean, just in seawater, right? If you had a magic filter, you could filter the ocean's water and have a pile of gold. The reason why people don't do it is because it's so minute that it wouldn't be economic, right? So you can't do it. So the thing about rare earths is some people will say 17 elements and other people will say it's 15 plus 2, right? And the reason is that there's 15 elements that are called lanthicides. Don't hold me to that, but it's something around that. Plus there's some other elements as well. So you've got the 15 lanthicides, and then you've got scandium and yttrium, right? So effectively you've got 17 different elements, and they typically found together. So what happens is when you're looking at a rare earth stock or a drill hole and someone's talking about rare earths, they'll dumb it down a bit and they'll say, this is the total rare earths. And you see that as TERO, right? And that's the percentage of all the rare earths together in a grade, right? So you might have 5% total rare earths, right? Which would be a really good grade, right? But of that 5% rare earths, it's going to be different for different elements.
Mm-hmm.
So with the reason why we're seeing people talk more about rare earths now is because rare earths are helping power the green revolution. So in a wind turbine, obviously you're going to have a magnet. So what happens is the wind turbine spins around and the magnet converts that kinetic energy into electrical energy. And that's done through a magnet, right? So a generator that's got magnets in it. Now those magnets have rare earths in them. So the perception in the world is that we're going to need a lot more rare earths to power the green revolution. And that's because we see rare earths in magnets, we see them in phones, we see them in EVs, we see them in fridges, we see them in microwaves. Basically anything that has electronics in it or magnets in it is going to have rare earths in it, right? So a little bit of history about where rare earths have sort of evolved and come from a mining point of view is that a long time ago in the 60s and 70s, there was a very large rare earths mine called Mountain Pass in America. And that was that one mine produced most of the world's rare earths. Now, you know, because we have booms and busts in commodities, what happened over a number of years was that China started producing rare earths and it became uneconomical for Mountain Pass to continue operating as a rare earths mine. So effectively what happened was that about 90% of the world's rare earths were mined out of China. So sort of typically in the 90s and the 2000s, rare earths was totally dominated by China, so 90-odd%. We then had a time in sort of the mid to late 2000s, where China was getting cranky at Japan. And so obviously Japan was a big user of rare earths and China was a big maker of rare earths. So both a mining and manufacturing, okay, or processing of that ore into the actual rare earths that Japan needed. And to sort of punish Japan, China put quotas on how much rare earths they would sell Japan. So that then meant the price of rare earths went up. So like anything stock related, when the price goes up and the price goes crazy, all the punters jump in, they all get excited because, you know, Linus is drilling a hole in the middle of WA and it's got, you know, $1,000 a ton worth of rare earths in it. And suddenly it's, oh my God, we're all going to get rich if we buy
because the price is definitely going to stay the same forever. Yeah.
Yeah. So, so I sort of, you know, because I've been around for long enough, I rode that initial boom sort of 15 odd years ago. So there were lots of companies like, you know, Linus was one, obviously. There was Globe, there was Peak, there was Arafura, you know, Hastings. There's a whole bunch of companies that then obviously, because, you know, mining juniors tend to chase, you know, the hot topic, you know, they obviously want to find the next big mine. And, you know, all the punters are saying, oh, rare earths. So they all go running off to looking for rare earths. Now, Linus has an amazing deposit. So Linus's deposit is Mount Weld, and that's in WA. And when this boom sort of happened 15 odd years ago, Linus was really the only Western company that really made it big in the rare earth space. And it wasn't without issues. Like Linus typically for the last 10 years has sort of been this really big company that's just never made money. Because what happened was the boom ended, and typically with boom and bust, the price goes back down. Linus really didn't have any experience in rare earth processing. So what they did was they would mine the rare earths out of WA. They would concentrate them. So they would make a concentrate. Then they decided they would ship that concentrate off to Malaysia, and they would take that concentrate, and in Malaysia, they would then separate the rare earths into each individual rare earth, right? Because if you're a company who's making a magnet, you don't want 17 rare earths together. You want, you know, nobibium or neodymium or whatever it's called for that rare earth. So
certain percentage of a specific rare earth.
so they're
in that.
just wanting one of those of that
Right.
17, right? So when you look at a rare earths announcement, what they'll typically do now, depending on the flavor of the year and the demand and whatever, is they'll separate that basket of 17 different rare earths, and they'll say, it might be 3% total rare earths, but it's 1% of NdPr. So NdPr is 2 rare earths that make magnets. So what they're saying to the market is the magnet rare earths that everybody wants, because that's their high demand, their high value, we have a lot of those, right? So when you're talking about rare earths, it's not just about the grade, it's also about the makeup of what's in the grade. So typically when the average punter looks at a rare earths announcement, they see a table with all these different percentages and they shake their head and they go, is this good? Because they don't know, right? What makes it even more complicated is that typically rare earth mines are split into 2 different categories. So you've got a hard rock deposit and you've got a clay deposit. So when you look at someone like Linus, that's a hard rock deposit. So effectively it means that the rare earths are still in the rock, right? And that's why they call it a hard rock deposit, because it's a hard rock, right? Okay. So when you're looking at hard rock grades, if you look at Linus, for example, their total rare earth grade, I think, is about 8%. It's one of the highest hard rock deposit grades in the world. Mountain Pass is quite high. I think it's even higher. I think historically it was maybe 15% or 12%.
Wow.
That Linus comes in at about 8%. But then when you look at a clay deposit, so from a geological point of view, that when you have a hard rock deposit, it weathers over time. So you'll hear geologists talk about weathering, and effectively means it gets rained on, right? That's effectively what it means. It gets weathered. A bit like your old weatherboard house. If it's in the rain, it looks pretty shabby after 20 years in the rain, right? So that's effectively what happens to rocks. So over millions of years, the rocks will weather, and those elements, those rare earth elements, will make their way into clay. So effectively, you've got all these little particles that are going, oh, I'm coming off the rocks, and they find their way into the clay and they get stuck in the clay. So the advantage of a clay deposit is that sort of that weathering and that processing has almost been partly done, because it's been weathered over hundreds of thousands of years or millions of years, finds its way into the clay. So when people talk about a clay rare earth deposit, which is typically what you'll find in China, is that those clay rare earth deposits have a much lower grade, because they're not the original source rock. They're not that hard rock. They're not that 8%, 10%, 20%, 40%, right? So when you start looking at the clay rare earth deposits, they're only maybe 0.1% or 0.2%. So they're a much lower grade. But the advantage that they have is that they can be processed easier, because they're already sort of semi-processed. So you might find an economic rare earth deposit in hard rock that might be, say, 1%, and then in a clay deposit that might be 0.1%. So I often see online people will go, oh, that deposit's crap because it's only 0.1% or 0.2%. Linus is 8%. But they're talking about clay versus hard rock. They're not understanding the difference, right? And then there's some other factors as well. So when you're processing these clay rare earth deposits, it's not just about the grade, it's also about the metallurgy. So for people that aren't familiar with metallurgy, effectively that means, how is it in the clay? What's the metallurgical properties in the clay, and how easy is it to extract those elements from the clay? So when you're looking at clay deposits, there's a thing called an ionic clay deposit, which basically means that for the average mug punter, it means that it's reasonably easy to extract those elements from the clay. So when you start talking about mining, it's not just about the grade, it's also about the metallurgical work. It's can I extract what I want out of the rock, out of the dirt, easy or hard, right? Effectively, right? So an ionic clay deposit is easier to extract the rare earths from than a non-ionic clay deposit. So not all clay deposits are the same. And then you have all the other standard mining issues, So for people that maybe aren't that well versed in mining stocks, there's a couple of big questions you ask yourself when you're looking at a mining stock or a deposit. Is it open pit? Is it underground? Right? If it's going to be open pit, how much waste dirt is on top of the stuff that I want? So when you're looking at, the best rare earths clay deposit is something that is at the surface, which means when I mine it, I don't have to take the dirt off and put the dirt somewhere and then get to the deposit. So if I've got to dig down 50 meters to get to my deposit, that's going to be a lot more expensive than it's just sitting on the surface, right? How wide is it? How long is it? Is it free dig? Can I just basically get a truck and an excavator and dig the stuff up and process it at surface? So like whether it's a gold deposit, a copper deposit, rare earth deposit, there's all those standing mining metrics that you need to look at, right? So is it easy to mine, and can I get the minerals out of the rock or the clay? But obviously rare earths have the added complication that there's all this other stuff on top of a standard, deposit that you look in mining. So I can look at a gold mine and I can say, hey, it's an open pit, it's 2 grams per ton. It's open, it's at surface, it's 30 meters deep and it's 100 meters wide and it goes for 10 Ks. Happy days, what a great deposit, right? But if I see that same 2 grams per ton at 300 meters below surface, then it's worthless, because typically gold mines have a cutoff grade of about 3 or 4 grams per ton, if they're going underground, because obviously underground mining is more difficult, it costs more, it doesn't always take out all that's right, it takes the metrics out of the argument, right? So the really nice thing about Lynas is that it's at surface. For them, the mining isn't the difficult bit. They actually have mining campaigns. They don't mine all the time. They literally go in, mine a whole bunch, ship it off, and then stop. Then they come back and mine again, right? Because the mining for them is easy. It's the processing bit that's the difficult bit, because of the whole separating the 17 different elements and all this sort of stuff. Now, I suppose the argument will be is that when you look at Lynas, and they're a really good example, and that probably evolves into sort of why people are so interested in rare earths, is that because there's so much processing and mining done out of China, suddenly or gradually, depending on how you want to look at it, but over about the last 10 or 15 years, Western governments have realized, oh, you know what, I want to make a cruise missile because Russia's invading Ukraine, but I get all my rare earths for my cruise missile from China.
Yeah, suddenly there's a supply security issue.
Exactly. So what they start to do is the US government goes, oh, bugger, we maybe need to encourage non-Chinese companies to make rare earths. So they throw a whole bucket of money at Lynas to change their business model a little bit, where they do some further processing of the rare earths in Western Australia, and then they ship the US a concentrate, and then in the US they then further do that last bit of the separations of the different elements in the US, right? So and it's not just the US, it's obviously Europe and Australia, and there's a whole bunch of people that have suddenly sort of going, you know what, having our military and technological future based on Chinese supply probably isn't the best thing to do. So that's why we're starting to see, I think, some movements in the rare earth space.
And so with that geopolitical importance of this strategic metal, how much of that really changes? All of a sudden, it's not a question of economics almost, right? Like people are saying it doesn't matter how much money we can save offshoring it. we need to actually have the supply and processing capability in jurisdictions that we control. So what does that really mean from an economics perspective for a Linus, let's say? So they can produce, and then what, the government's just going to kind of make up the difference between what they would have lost because it's too expensive to process here, but we need to do it because we need to have the supply. How does
So
that change things from like an income expense point of view?
yeah, so I think governments are interesting where they can't really be seen in propping up an industry. They can't be saying to Linus, hey, for every kilo of NdPr you produce, we'll give you $50. They won't subsidize the price, but what they will do is they'll say, hey, we'll give you $500 million if you build a processing plant in the US. So obviously mining is an expensive business, and if you can basically give a whole lot of cash to companies to get mines up from the ground, they'll go, oh, thank you, and then that will obviously lowers their capital costs, which then encourages them to mine those elements and whatnot. So we just saw recently the US government give out a whole bunch of funding to lithium plays and graphite plays and all those strategic elements that they've decided is important for security and EVs and batteries and whatnot. So you saw SYR get some for their graphite mine in Africa. So there's a whole bunch of government grants they give out, basically just throwing cash at the problem, which works, right?
Okay, interesting. The RBA may beg to differ in terms of stepping in to prop up certain industries, looking at their 0.25% raise today. Nothing to see here, guys. Keep moving.
Yeah, exactly.
But it'll be interesting. Okay, that's fascinating. In terms of like wrapping up this sort of macro segment, you mentioned China, was a dominant player. Now things are starting to change. We've spoken about Linus in WA. Where else are these rare earths in such a concentration that makes it viable? Like, where's the mining, the processing, and the production at the moment outside of, say, WA and China? Who are the other players in this space?
There isn't a lot of players. Like, I think if you talk about China, you're also talking about Mongolia.
Right.
So there are other places that hold them, but rare earths is a fairly specialized industry, and we're starting to see other companies start to get some traction. So, for example, HAS, which is in the Gascoyne region, so Hastings, and Arafura, which is in Northern Territory. So they're currently building mines. And then you've got some mines that you might say are, what's the word? Related to rare earths. So they're not that typical NdPr, but they're some of the other elements that are also important, that are potentially going to get up. So ASM, for example, they've got their Dubbo, the project at Dubbo. So there's a whole bunch of things where people have typically found the deposits, done some of the scoping studies, and now they're trying to get the financing, or they're building. So HAS is building theirs. I think Arafura is building theirs. HAS was being backed by Twiggy. He's and then that sort of goes into some of the other players. So at the moment, the Gascoyne area in WA is quite exciting from a shareholder point of view, in that you've got Hastings that are currently being backed by Twiggy, and he's invested some money in them. And then next to Hastings is Dreadnought Resources, which is DRE. And their share price has probably gone from, I think 2 years ago, it was half a cent. I think it's now 11, 12 cents. It's sort of gone from that 30, 40 million to 400 million market cap. And that's purely on discovery. That's a deposit called Yin. And then you've got some of the other players around the Gascoyne, like Kingfisher and a few others, that are finding some interesting geology around that. And there's definitely some interest in the market coming up where, like for anyone that follows me on Twitter, WA1, so WA1 Resources has sort of seen their share price probably tenfold in the last week. So it was 15 cents and hit $1.99 today on their find in the West Arafura region in WA, which is sort of on the WA Northern Territory border.
And so where's their market cap move to now?
So they I think I tweeted they after the announcement they're up from I think they're about 15 cents. I think I tweeted about them when they were about 26 cents, and I made the comment that they were 13 million market cap with 3 million cash, so they had a 10 million EV. So, and the interesting thing about WA1 was that they've found effectively the whole length of the hole, or we think potentially the whole length of the hole in some sort of mineralization. So they're a little bit different in that they are, let me get this right, Nobium. So when you look at Mount Weld has, so Linus Mount Weld deposit's really interesting in that, for a little bit of background, a lot of geology and a lot of mineralization, copper, rare earths, gold, it's all around volcanoes, ancient volcanoes, right? So typically with, so Mount Weld, for example, is effectively like a distinct volcano. So basically you get shit come up from under the ground, and then over millions of years that weathers away, and you get this sort of core of carbonatite, which is sort of like a rock type. And in that rock type, you have all this mineralization of rare earths. So typically when you go looking for some sort of deposit, it's around ancient volcanoes or lava flows or this sort of thing, right? Or vents, sea vents, something to do with stuff coming up from the earth and then, doing its thing and concentrating into an economic deposit, right? So when you look at Mount Weld isn't just one deposit. It's actually a series of deposits all next to each other, and each deposit has a different makeup depending on what was going on with the volcano at the time, right? So a bit of a visualization, I suppose, is if you look at a modern day volcano, you'll see a peak, and then you'll see lava flows going everywhere, and it's not just one nice harmonious bunch of activity for 3 squared kilometers, right? It's a whole bunch of different things happening. So as all those different things happening, and the deposits form, so they're not uniform, right? So when you look at Mount Weld, you'll have a big area which is like the Nobium deposit, but then within that you've got the rare earths, and then you've got tantalum, and you've got phosphate, and you've got all these other things. So you could easily say, oh, if rare earths weren't a thing, that Mount Weld is a Nobium mine, or it's a phosphate mine, or whatever. So phosphate's like fertilizer, right? So the interesting thing about WA1 was that they drilled a hole and they didn't bother with the first 70 odd meters because they weren't looking for rare earths. They were looking for an IOCG deposit, which is an iron, what's the O? I don't know, but copper gold. So effectively iron, copper gold. So, that you're talking about the Olympic Dam style of, really big sort of deposit with iron and copper and gold and that sort of thing. So it's a sort of geological formation. So they didn't even bother essaying the top 74 meters because you're not going to find an IOCG deposit in the weathering part. So typically what happens when you look at deposits is the top 50, 100 meters is weathered. It's been affected by water over the years, right? So when you're looking for certain types of deposit, you might ignore the weathering layer and you're looking for what they call fresh rock, which is the stuff where the water hasn't penetrated.
So you got to dig to get to that.
So you've got to drill 100 meters down. So typically with nickel deposits is you're looking for nickel sulfides, which are nickel mineralization that has not weathered, right? So typically there's not a lot of point looking in the first 20 meters. You got to look, 200 meters down, 100 meters down, typically. Not always the case, but that's sort of typically. So because they were looking for IOCG, they didn't even assay the top 74 meters. So what they did is they assayed the 74 meters to the bottom of the hole, which was, say 220 meters or 210 meters. And that whole section they assayed had mineralization in it, which is like, hang on a sec, what the hell have we found here? Because they sort of found something that they didn't even really know they were looking for. Good luck, I suppose. But what they typically do, and the way exploration typically works, is they'll run some geophysics. So they basically have sensors that measure the density of the Earth, the magnetics of the Earth, the electrical resistivity of the Earth, whatever they can do to sort of give them a map of what the Earth looks like. And then based on that map, they go looking for mineralization based on what that map tells them. So typically with a mining announcement, you'll see a picture of the thing with all these different colors, and they'll go, oh, that looks really exciting because that's white, and it's not because they've gone out and painted white on the ground. It's because that's what the sensors, the survey is telling them. So that gives them a hint to where they should look. So basically WA1, they went, oh, we have an area, and they actually call it the duck because it looks like a duck. It's got a head and a body, and that sort of image looked like a duck. So they drilled one hole in the duck, which was P2, and they basically, everything they assayed had some sort of mineralization in it. Now, so what they're then going to do is they're going to go, hang on a sec, we need to go measure that top 74%, because the top 74 meters, because typically it's the weathered part of a rare earths hard rock deposit that's the really high grade stuff. So they just basically, they think that they may have ignored the best bit, and then the worst bit actually had like economic grades of rare earths in it. But it's not a typical rare earths as in a TREO, it's a nobium rare earths. So then you start going, what the hell's nobium, right? So there's only about 3 or 4 nobium mines in the world. And they typically run at somewhere between 0.2 and 1%, I think. Or, maybe the best one's 2%. But effectively, they're a fairly low grade, because, So these guys basically had 160 odd meters worth of mineralization. Even at the end of the hole, it was like the last 2 meters was 1.2%. So,
wow.
So like they just basically just went, and typically with exploration, you don't just drill a hole and you find the best bit, right? That's not how exploration tends to work. You tend to pick a random spot, drill a hole and go, oh, that looks interesting. But if we go 50 meters that way, 100 meters that way, and then they chase it, right? Oh, that was a bit better, or that was a bit worse. And it gives them some idea of what they're looking for. So the fact that they basically drilled a hole in a 3 kilometer sort of radius or diameter and just went, let's just drill a hole here. Oh, look, we have economic mineralization,
Fancy
and
that.
then they drilled 3 holes in P1, which was about 10 kilometers away, which was something else that looked interesting that we're waiting on the assays for. So I think for something like WA1, the reason why it's gone from sort of 13 million market cap to today, I think it got to about $2, $1.99, and that makes it about 88 million market cap, is because not so much of what they found, but what they might have found. And this is the thing that a lot of people don't understand in the exploration game, is they'll go, oh, but this other mine that's got 20 million tons at 1%, it's 100 million. So how could it possibly be worth more than that? Because they've only drilled 1 hole. But it's that concept of, yeah, but what do they have? It's sort of a bit like the story, someone says, you're better to keep your mouth shut and look like an idiot than open your mouth and prove it. And it's a bit like that. Like with exploration, it's not so much what you have, it's what you might have. Right. So I know that those guys have got 20 million tons at 1%. And that may be just borderline, or it might be good but not great.
Right? So does everyone else now.
But so does it. But these guys have drilled 1 hole, and suddenly they have something that looks pretty good. And when you look at the geological model of Linus, you realize that they have this sort of halo of this nobium at sort of 1% odd, but then they have within that big circle, they've got little circles that have rare earths at 10% and all this sort of stuff. So it's sort of a bit like, you know, I've got a note in my hand. It could be a 1, a 10, or 100, right? If you don't know what it is, what are you willing to pay for that? You might go, oh, $20 because it could be 100, right? But if I say to you it's a 10, then you go, I'm not going to pay $20. I know it's a 10, right? But on the chance that it's 100, you're willing to pay more. So that's sort of what happens in exploration, is that it doesn't necessarily mean what you have, but what you might have. You've got to factor in. And this is sort of goes into some of the return on investment stuff. So I'll look at, so I looked at WA1, for example, and I went, okay, it's a $13 million company that has found something, or could have found something, right? And then I go, what's the risk versus reward of this as a purchase? So any stock I buy, I think it's good for an investor to go, what's the risk versus reward metric? Because, you know, if I buy a stock for $1 and I think, look, worst case scenario, it'll go to 80 cents. And the risk isn't huge. I'm risking 20%. But if the reward is potentially $10, well then, I'm buying it for $1 and it's $10. Well, that's good risk versus reward, assuming that I've got a 50-50 chance of it going to $10 or going to 80 cents, right? If I've only got a 1% chance of it going to $10 and a 99% chance of going to 80 cents, well, then the risk versus reward doesn't work out.
That expected value drops quite a bit.
You know, so everything I tend to invest in, I tend to look at risk versus reward. What am I risking and what's my potential reward? So I think that's, you know, you talk about return on investment, right? So we sort of go into this whole return on investment. You've got to make the numbers work for you. You're never going to get it 100% right. Like, I've been doing this for 20 years and I will still today lose money on a trade or a stock or a purchase, because I'll look at a stock and I think, oh, it's at 2 cents. If they find something great, it could be $1 and it's now 2 cents, right? And maybe the risk is it goes to 1 cent, which is still a 50% loss from 2 cents, right? But if it's sort of 60% they'll fail and 40% they'll succeed, then to me that's good risk versus reward, because whilst there's more chances of the risk, if they do hit the reward, then it's more than, you know, halving my money. It's like 10 times in my money, right? So,
and how are you estimating what the potential market cap could be if, in this case, let's say their drill results come out really well? Are you looking at like previous other examples of similar companies or similar stories and saying, well, they had a similar deposit and they reached their market cap of X, this company's in a very similar spot, and, you know, should they get the right drill results, they could at least match that market cap? Or how do you go about estimating?
Yeah, and I think that's sort of where the experience comes in, because, you know, it's to some extent it's an art more than it is a science, right? Like, I look at stocks and I go, oh, that's worth 500 million. But then in the same instance, I go, yeah, but I wouldn't touch it at 500 million. Just because it's valued at 500 million doesn't mean it's value, right? So part of that is to actually go, all right, well, you know, what's stock that I potentially like, or I think it's got a future, or it's in a good industry, or it's in a good segment, and what's its value, and would I be willing to buy it at that sort of price? Okay, I'll compare to that. So to sort of give you a bit of an example, I spoke earlier about the Gascoigne, and we've got Has, who is building a mine. We've got Dreadnought Resources, which is next to them. They've found the Yin deposit. They're about $300-400 million, and they're rare earths. So I wouldn't necessarily buy DRE, which is Dreadnought Resources, at 400 million, but I don't think they're stupidly overpriced. I think they've got a good deposit, a good honest deposit. They're finding the stuff, and I think, you know, it's fair, right? So based on that, you know, I look at something like Kingfisher, which is stock code KFM that we sort of talked about, and they're a bit earlier on. They've had a couple of drill hits. They've done some rock chips. They're looking at the geology, and their market cap's about 25 million. So I look at Kingfisher and I go, okay, so whilst I wouldn't potentially buy DRE, I don't mind them as a company. I think they're probably a good valuation. So how do I compare Kingfisher compared to DRE? So Kingfisher's about 20, 25 million. These guys are 400 million. What's the chance that Kingfisher could replicate Dre's success? They're in the gas coin. They've got large holdings. They're finding 20 and 40% in their rock chips. They've drilled a couple of holes. They had a hole which I think was 3 meters at 5%. So we know they have mineralization. We know the geology supports mineralization. They just need to, I suppose, hone in, target in, drill some more, find more of it, see if they've got enough of it in an economic concentration. And from all accounts, they could. They've got a good chance of doing it. Risk versus reward, right? So I look at someone like KFM and I go, what's the risk versus reward metric on that? They're 25 million. If they can replicate Dre, they could go to 300 or 400 million. So 400 million is 16 times market cap. But, that's pretty good reward, So if I think, what's the downside? Okay, well, they might go to 10 million if they start finding nothing. But they've already found some stuff. So maybe the risk is 50% downside, but the potential reward could be 10 or 15 times upside. Right? So if I say, oh, there's probably a 50% chance that they'll find what I think they might find, then for me, those metrics work from a risk versus reward standpoint. Doesn't mean there's no risk. Doesn't mean that if I buy them and they don't go to, they don't go up 10 times, I'm an idiot. It means what I did is I took an educated guess and said, do the risk versus reward metrics work? And that's what I did on WA1 last week, was I said, okay, we know that they've got something interesting because they're basically, the whole hole is mineralized. It's a random hole in a target. It's next door is Rio Tinto spending $60 million to farm into the next door neighbor. So obviously Rio Tinto gives some sort of validation that there's something interesting in that part of Western Australia, in that they're spending $60 million to farm into someone else's tenements. So at 13 million, do I think that there's good value given that Rio Tinto is spending 60 and these guys have found something? So I sit there and I go, oh, well, I'm pretty happy to buy it 26 cents. And then 5 days later, it's $2. So this is the sort of,
and do you time that entry around drill results being announced?
I didn't even know they existed 5 minutes before they announced it.
Okay.
So, and people ask me, how do I see this stuff? How do I do it? Et cetera, et cetera. I literally, I don't even think I saw the announcement. I think they opened, I've got on my screen, I've got a list which is effectively ordering stock by price increase. So by this stage, they'd already were up 50, 60%. And I went, oh, why are they up 50%? Because usually, they need something needs to happen for a stock to be up 50%, right? So I looked at the announcement and went, oh shit, they found, oh, that looks interesting. I sort of culminated 20 years of experience and went, should I buy? Right? Literally making a fairly large purchase decision based on skim reading an announcement. And I went, and I very quickly assessed that the risk versus reward looked pretty interesting. Doesn't mean there's no risk, but it looked pretty interesting. So what I typically tend to do is I tend to buy in chunks. So I don't, even on something that I think is amazing, doesn't mean that the market will think it's amazing. People have this perceived thing of the market is efficient. And my argument is no, the market is the most inefficient thing that you can ever come across, right? And if it was efficient, I would never have an opportunity to buy something at 26 cents when I think it's worth $2. Right? So, my whole trading strategy is on market inefficiency. The fact that someone can find something and it takes time for the people who need to know to find out about it, it takes time for them to know about it. And I'm going to be faster than the next person, right? But the risk is that the right people never find out, or I'm wrong in my assessment of thinking that's a good buy. And that's the risk portion of the risk versus reward. So there's been plenty of times where I've bought a stock held it for the day or 2 days and it's gone down. And I've gone, oh, I must have got it wrong or whatever. And I sell because, I don't want to be left holding something that I got wrong. And then 3 days after that, it's 3 times the price of when I sold it. Right. So, and that's probably the really frustrating thing is that ultimately you can be right and still lose money, which is a very annoying and frustrating thing. So
yes,
it's that timing component as well, so the whole trading thing is not just about working out what something that's a good risk versus reward. It's also about timing. It's also about marketing. It's also about people knowing about the stock. It's there's a whole bunch of things that go on. There's a whole psychology around it. It's not just about did they find something good. Plenty of stocks have found something good and do nothing for a year or two, and then suddenly they'll announce something that was pretty much the same as what they'd already announced, and suddenly the stock goes up. And you go, well, why did it go up then and it didn't go up 3 months ago?
Yeah, it was interesting to see, you talk about market inefficiencies during last year, or even further back when you had coal prices trading through the roof and Whitehaven coal not moving at all. It was like this alligator jaw of what they were selling was going through the roof and the stock was just going nowhere. It was just this obvious disconnect. But yeah, as you say, it takes some time to pull liquidity into a thesis like that, I guess, at times.
Yep.
I would love to ask you about your highest ROI from any investment to date. I'd like to get some of the numbers, if you've got them, and a story as to what it was and how it came about. Be very interesting to hear.
It's sort of really hard. I've had quite a few, but anyone that tells you they don't lose as well as winning probably are telling big thurfies, right? So I have an interesting metric, right? I have an interesting story. So I'm going to start this with an interesting story. The people in trading, you'll get people who will tell you the story about Fortescue. Oh, I bought Fortescue at 20 cents and then it went up to $30 and I'm rich and I'm a legend, and that's the dream for a lot of people, right? They buy a penny stock and it does something amazing and then they retire, right? And all they need to do is hold it for 10 years and they'll retire. Typically those stories are few and far between, right? And you don't see too many people that are 100-odd millionaires because they bought 10 grand in a penny stock and a mining company, it became Fortescue. So whilst I tend to have a few stocks where I've made 20 times my money on, typically they're really interesting stories in that I'm not a buy at 2 cents and wait for $1 type of person. And I don't think most people should be either. And I'll tell you why. I think for every company that goes from 2 cents to $1, there's 20 companies that go from 2 cents to $1 and back to 2 cents. So if you're waiting for, a 50 bag or 100 bag on a stock, you're probably going to get the first 10 and then you're not going to get the other 40 and you're going to lose the 10 that you made. So one of the things that I've sort of developed over the last, 10 years, I suppose, more so in my later start of my trading, is I like to ease into a stock and I like to ease out of a stock. So what I mean is that I will tend to, if I like a story, I'll tend to buy chunks, right? So I will buy a parcel and then I'll buy another parcel and then I'll buy another parcel and I'll buy a parcel, right? Unless it's something where I think it's pretty extraordinary. If it's just something that I tend to like, then I typically don't buy it all in one go. And then when that stock does well, I tend to start selling parcels. So say for example, I buy a stock at 10 cents, right? Let's say that stock, and I buy a couple of parcels over a few days. I might buy at 8 and 9, at 10 and 8 again, right? So let's say my average is 9 cents and I did that over a couple of weeks, right? When that stock gets to 30 cents, because I think it's got some really good value and the market starts to recognize that it's got value, if it gets to 30 cents, I'll probably sell a quarter. Even though I think it might go to $1, $2, $3, I'll sell a quarter. And people will say to me, but why would you sell it? If you think it's going to be this U-Butte amazing, $20 stock, why would you start selling at 30 cents, right? You've tripled your money, sure, but why would you sell if you believe the story? And I'll say, because I don't know the future.
Mm.
I don't know if they're going to do a capital raise at 20 cents tomorrow, or, there's going to be bad news. So I'm happy to forego some of my future revenue, some of my future profit, to lock in some profit today. And then it might go, say it goes to $1, then I might sell another 25%. And then it might go to $2 and I might sell another 25%. And people will go, oh, you're crazy. If you just kept it all, you would have, now you've only got 25% left of what you had, and it's gone from 10 cents to $2. You'd be rich. I'd be like, yeah, but I've also seen stocks go from 10 cents to 30 cents. I sold nothing. And then 3 months later, it was 5 cents. And I go, oh, I should have just sold a little bit.
Yeah, that
I
back
should
end of
have.
the hockey stick is just as sharp as the front end. Yeah.
But that said, I've had some amazing runs. I caught one stock. It was called Biotron, BIT. And I got to preface this with the Australian biotech sector is horrid, right? And you need to understand that it is horrid. And what I mean by horrid is that the ASX investor will fall in love with a biotech, and a week later they will hate it, and that is reflected in the share price. So you will get amazing stories in the biotech space, cancer cures, diagnosis, potential remedies for diseases that have no remedy, right? That potentially could be life-changing, and they could be sitting on the ASX at $20 million. The ASX will not give it any worth or value, right? But then they'll come along and they'll announce something where it'll be, oh my God, this potential is amazing, and it should be like 20 times what it is. So I held a stock called Biotron, which has a potential cure for HIV. So HIV, most people will know that there's drugs that cure HIV, that doesn't cure HIV, but it suppresses HIV that people can live a normal life. And what Biotron think they've got is a way of clearing out the last of the HIV out of the cells to effectively cure people from HIV. And all their clinical trials turn around and show that, this is the potential of this drug, right? But drug development is a 10-year process, and ASX investors struggle to hold things for more than a week. So they came out with news a couple of years ago around their drug, and I'd followed this drug back in 2008 when they first realized in the lab that it could potentially do what you could do this. And now we're talking about human trials, and it's showing that it works potentially in humans, right? And it also has some flow-on effects for long COVID and a few other things, right? But that stock went from 2 cents to 44 cents in about the space of 2 weeks. So that was a 20 bag in a couple of weeks, right? That was, and to make the thing even more interesting was they had options. So for people that don't understand options, effectively an option is the ability to buy a stock at a certain price, and it usually has an expiry date. So Biotron had options, so it meant that I could buy their options. So the option to buy a stock at, say, 4 cents. So rather than buy the stock at 2 cents, I could buy the 4 cent option and only pay like 0.3 of a cent. Now the options went from 0.3 of a cent to, if the stock's at 44 cents and it's a 4 cent option, it went from 0.3 cents to about 40 cents. Right. So that was like 100 bag, right?
Yeah.
So I was and they had they had stock. I think they had a 2 cent option and a 5 cent option, right? So as the stock went up, I was arbitraging the options and the stock. And so, I would, so for example, the 5 cent option when the stock was 8 cents, the 5 cent option should be worth 3 cents, but it might have been trading at 2.5 cents.
Uh-huh.
So I was buying options at 2.5 cents when the stock was 8 cents, and then the stock would go to 10 cents, and then like, so I was playing this daisy chain of buy, sell, all the way from sort of 2 cents to 44 cents. And the interesting thing was I didn't hold it at the time they announced this announcement that made them the share price rocket. But because I'd traded the stock 10 years previously and I knew the stock really, really well, and I used to be a long-term holder in it, I could jump in basically on the announcement and then know and watch the volume and the action to go, I'm going to start hold this and hold this and hold this. But then I sold, because you look at the stock today and it's like 3 cents, because the ASX just is impatient with drug companies in Australia because people get bored, right? So the ASX biotech space is littered with stocks that go up 20-fold and back down 20-fold, you know, all within the space of like a year or two. And it's nothing that fundamentally changes, it just people get bored. It's amazing, right? The ASX is just littered with the shell of the bleeding carcasses of biotech companies. Right? And to some extent, they're the same with mining companies, except that it's usually with mining companies because they don't deliver on what their potential is. So like I said, with WA1, they drill a hole and it's not necessarily what they have, but the potential. So if you keep drilling holes and you're not finding what people want you to find, then the share price will go down, right? So there's my pinned comment at the moment in Twitter. I don't know if you go to my Twitter, you'll see my pinned comment, and it's about me commenting on a stock called Orcrombe, I think that was called. It was ORE, right? And at the time, it was a $10 million lithium company. And that company today is called AKE, and it's got a value of about something in the billions. It's the world's biggest lithium company. Now you
would said here $6 billion.
$6 billion, right?
Yeah.
So I was, and the comment I was making at the time was, I put this post up on Hot Copper, I think it was, Hot Copper, and I had 0 likes on this comment that was, hey, I think these guys have got potential. They're only worth 10 million. All right. So that was 10 years ago, Wow. So did I hold it till $6 billion? No, I didn't hold it to $6 billion. I have a thing called stock ADHD. I see something with potential and I go, oh, I really like it. And then I see the next thing with potential and I go, oh, new, shiny, that looks pretty. Maybe I should sell that one and buy that one. So I've probably, I think part of it being a trader, but I think last financial year I did 3,500 trades on the ASX.
Wow, that's a lot of volume.
And then, part of that is just daily churn and looking for pips and stuff. But other parts of that is buying long-term stocks and just holding. And I made the comment to a fund manager guy I know about Dre, and I said, I looked through my records. I sold Dre 3 years ago at 0.6%. Today it's 12. So there's, and I bought it because I liked it, right? So that's 18. So my trading career, my investing career is littered with missed opportunities, selling things way too early, selling things too late. But the thing you learn when you trade, or when you trade for a long time, is that's just the game, right? You don't live your life going, oh, but if I'd held, or if I'd done this, and part of that is also around my strategy, going back to the return on investment, how much, what have I made, what have I, etc. Is I've learned I'd rather bank, 4, 5 baggers than try and chase 120 bagger, because chances are you're not going to get that 20 bagger. It's not a 3-month, 6-month, 8-month proposition. It's 10 years, and there's missed opportunities in that 10 years, and you're not always going to get it right. And I've learned now that it doesn't hurt to take some profit along the way. You don't have to be all in or all out. This is something I try to explain to people who come to me. I have people come to me on Twitter and say, can you mentor me? Can you help me? Can you explain stuff? And one of the things I say to people is, you don't have to be all in or all out. There is a middle road. You know, if I'm holding something that's 10 bagged, it probably means I'm really, really overweight in it now. Because if I've got 10 stocks and I've got 10% of my portfolio, like I've got, say I've got 100 grand, right? I've got 10 grand in one stock and it goes up tenfold. I've now got 100 grand in that one stock. If my other stocks haven't moved, I've got 100 grand in one stock and 90 grand in the other 9, right? So now I'm 50 odd % in one stock. That's not diversified, right? So, you know, whilst it's great to say, oh, I held a 20 bagger or a 15 bagger or whatever, in reality, it's a really dumb thing to do because it probably means you've got excessive risk in that one stock because you haven't sold any. So my argument would be is you should be selling some on the way up because A, it might go down, right? And if it does go down and you still really like it, it allows you to buy back in and you can either lock in some profit or you can buy more because you've got the funds there that you've, you know. So for example, AW1, right? I bought a whole bunch at 26 cents. I sold some at $1. And not because I didn't think that I thought it didn't have the ability to go to $2, because I don't have a crystal ball. I can't see what might happen. So if I sell some at $1 and it goes back to 60 cents, I can buy it back again. I can buy back more, right? I can have more by doing that, right? Sure, I might forego some of my potential profit, but I'm also de-risking as I go through. And I have the ability to buy back if I want. And if it keeps going, I've still got like 75% of what I had. So am I really going to cry that I made, I made 3 times on 25% and I made 10 times on the other 75, right? But new investors tend to believe they have to be all in or all out, and that's one of the hardest lessons I think for people to learn is that, you should be de-risking as you go along because it's offsetting the risk in your portfolio. It's allowing you to buy back if the price drops, that sort of thing, right? So, when people talk about, oh, what's your best return? One of your questions, tell me the story of your 20 bagger. It's like, well, are you showing me that you really didn't have portfolio risk management in place because you let it go 20 bags?
Yeah, it's an interesting way to look at it. Yeah.
So, and plenty of people have got a 20 bagger or 10 bagger or whatever, and that's great. All I'm saying is it's not a bad strategy to de-risk along the way, and you can ease in and you can ease out. And so, I've got currently WA1 shares, but I don't have as many as I did when it was 23 cents. And part of that is because the risk reward has changed. I might think it's worth $5, but it's now $2. So there's not as much reward as there was at 26 cents. And the risk is now a lot more, right? So as your risk reward metrics change, you should be adjusting your holdings as you go, right? So it's one of the things that I think in the last 20 years I've probably gotten better at is that whole edging into a stock and then exiting, like slowly exiting rather than just being all in or all out.
It's really, really sage advice, and using that layering, entering and exiting in tranches, and then don't be afraid to rebalance when it comes to risk management. Well, thank you so much for that. I used up a lot of your time, but I'd be fascinated to catch up with you down the track in a couple of months and talk to you about any changes we may have seen. And I'd be really interested to do a bit of a deep dive into the copper market. So if you're happy, I'd love to save that for next time. Is there anything? We'll have your details for Twitter in the description. So guys, please make sure you are following along on Twitter. Is there anything I didn't ask you that I should have that you'd like to say before we wrap it up?
No, I just, I think it's been a really good chat. I tend to find that my chats go for a little bit longer than people think. I've done some chats with Emmanuel from Debt Capital. I noticed you interviewed as well, but I think, our chats usually go for about 2.5 hours. So
yeah, they're epic. I love them. Yeah.
We've done coal, we've done rare earths. So feel free, guys, to check them out. Some of them are still available. I know our rare earths one's still available. But mate, just if you want to find me on Twitter, you can find me at Twin Turbo Celica, and that's with a one, not an L in the Celica. So yeah, you can find me on Twitter. I'll try to
That's
answer all the
amazing.
DMs when people reach out to me. Obviously, I'm not a financial advisor, so I'm only just giving very general advice and sharing some war stories and whatnot. So, but yeah, I hope people have enjoyed the chat, and yeah, look forward to doing a copper one.
Yeah, absolutely. Now, my head is still spinning about the rare earth, so I'm going to give it some time for that sediment to settle. Thanks very much for listening, guys. Make sure you follow Twin Turbo Celica on Twitter. The details will be in the description. For now, take care, and I look forward to seeing you in another episode of the ROI podcast.